And welcome back to Overnight Accountant's course on Realtors and reducing taxes. Now we're still in the home office deduction section of this course, and we are discussing the actual cost method of taking the home office deduction. And this section is on depreciating your home. Now this can be a little complex, so we're going to go over the basics. So make sure you're aware of basically how it works when you're depreciating the home portion of the office portion of your home office. Particularly if you're doing this yourself, we want to make sure you have an idea of what you need to enter into the software. Also, if you have a professional preparing your return, we want to let you know basically what you need to give to them so they can properly prepare your return and calculate the depreciation of your home office. So the reason I'm saying this is because there are many errors in this area. Many times we have folks that prepare their own return in this area. Oftentimes they make mistakes for depreciating the home. Either they don't understand what their software is asking them to do, they just completely overlook that section of their software, or they just don't take the home office deduction at all, or they enter the wrong percentage, or oftentimes they'll just try to take 100% of their house, which they can't do as depreciation, or they forget to carry it over from year to year. Many errors happen in this area when I discuss depreciation in general on do-it-yourself software users, and also there's many errors that can occur. Actually, there's many ways to mess this up, basically is what I'm saying. So for that reason, I do recommend a professional. If you're taking the actual expenses on the home office deduction, we do that often in this course. Professional, you're going to find oftentimes is a good investment. We want to help you still minimize your taxes by providing you all the information on deductions that you can get so you can minimize your taxes as a real estate professional. But you must depreciate the business portion of your home if you have a home office. So I have must underlined there. That means you have to do it, because if you don't do it, the IRS rules specify that you need to treat it as though you did depreciate it. So even though you didn't get the benefit in prior years of depreciating your home and you sell your house, you could end up in a situation where you have a capital gain, but you never got to write off the expenses associated with that part of your home. That's not cool. That means you're going to pay more taxes than you otherwise would. If you sell your house later, this is going to create a tax due. So when you depreciate your home, what I mean when I say that is you're writing off a little portion of that asset every year, year after year, while you're using it for business purposes. And what can happen when you write that off, so you get to expense it, when you later sell that property and you sell it at a gain, it can create a tax due. Years ago, this wasn't the case. There used to be a rule or a belief that if you lived in that home, you quit using it for a home office, and you didn't use it for 2 out of 5 years, that you could exclude any gain, including that depreciation. However, that was specified a few years ago. That is not the case. Year after year, you have to keep track of your depreciation, because it will create a taxable event if you sell the home. Now, if you're a renter, good news is you really don't even need to watch this section. Because you're renting the property, you don't own it, you really don't have anything to depreciate as far as a home or a home office goes. So what you're deducting instead of depreciation is you're deducting a percentage of that rent you're paying every month. So as you learned in an earlier section, that's not a bad deal for renters taking actual expenses on the home office deduction. Want to make sure you're aware of a couple things. If you're a do-it-yourself or software user, these are some of the areas that people make mistakes on. Make sure, please be doubly careful that you properly enter the info into your software. Make sure that view the return and make sure that depreciation is following over to the proper line on the 8829. Make sure it's not going to somewhere else on the tax return. You have to really specify and tell the software what to do, or it won't do it properly. Also, make sure you use the same software year after year, whatever software you're using. And the reason I'm saying that is because there's a lot of this is where a lot of mistakes are made, is items from one year with regard to both auto expense and depreciation. They carry over from one year to the next. So if you're not using the same software that's not compatible with what you used before, chances are you're not going to know manually what you have to enter. You're not going to even know where to put it if you know you have to manually enter something. So also remember, always update your software from the previous year. And I don't mean do a software update in the software itself. I mean, if you're going from like, if you're watching this in 2018 and you were using 2017 software for your your return for the previous year and you're doing your own return, make sure you do what we call pro forma. Make sure in your 2018 software you bring in all that information from 2017. If you don't do that or don't do it properly, your tax returns, you just messed up your tax return for not for this year, but also for all the future years. You know, one of the things that create a mess is a snowballing effect. So make sure you do that. Also, keep depreciation, keep track of the depreciation every year, even if you stop using the home office. If you stop using the home office, remember, as I said earlier, that can create a taxable event if you sell your home. So make sure you keep track of that information. And it's not going to print out with your tax return. That's not really what you send in to the IRS. There's going to be a sub-schedule or a schedule in there called depreciation schedule or something to that effect. Maybe it's a federal depreciation schedule. Make sure you print that out and save it, because if you quit using your home for a home office and 6-7 years later you sell your home, that still can create a taxable event years later. If you're using a pro, make sure they have all the info they need. Make sure they have that depreciation schedule. If you did it from a previous year, make sure they know what carryovers are from prior years. So make sure if you're given a copy of your prior year's tax return, if you're going to a new professional, or if you're going to stop doing your own taxes and get a professional, or if you're new to real estate and you said, hey, I can't do this anymore, I need to get a professional, make sure they have a copy of last year's return and any supporting schedules that go along with that may include carryovers that they need to know about. Okay, depreciating your home, it is reported, depreciation is reported in Part 3, or it's actually calculated in Part 3 of the 8829 form, and that is this section here. If you have your 8829 with you, you can take a look at it, and that's basically what it looks like there. It's line 36 through 41. Now what happens here is this amount from line 41 then carries over to line 29. So it's actually reported right there on the 8829, but it's calculated below. Now, some of the things you need to know to calculate depreciation, or some of the things your professional is going to need to know. So if you're doing your own return, or if you have a professional, you need to know this. I want you to understand what you need in order to properly calculate depreciation of your home. One of the things you're going to need to know the smaller of your adjusted basis or the fair market value of your home. And you notice I say the smaller of. And there's a reason for that, because you have to use the smaller of what we call adjusted basis, which we'll define in a few minutes, or the fair market value of your home. You're also going to need to get a good idea of the value of your land, the land on which your home sits, the land you purchased with your home, because you cannot depreciate land. Land is an asset it's a non-depreciable asset according to the tax code. So you can't depreciate that. So you need to know what that is. You also need to know the business use percentage that we discussed earlier, and that's going to be up here on the top of your 8829. So we've already calculated that, but you need to make sure the software knows that also. Make sure it's calculating depreciation based on that percentage. As I said, there's many mistakes that are made in this area. So I'm trying to make you aware of what you need to double check in your software to make sure you're doing it right if you're doing your own. So we don't want you to make any errors. All right, let's discuss the adjusted basis a little bit. What is the adjusted basis? Now, roughly speaking, when I talk about adjusted basis, it really means your remaining investment or your investment in an asset. So it basically means, as we're talking about it here, it's going to be the purchase price of your home plus the cost of major improvements. Now, if you want to get really technical about depreciation from a professional standpoint, we would also say your adjusted basis would be, the purchase price of your home plus cost of improvements minus depreciation if you've claimed in prior years or the current year, because that's really how you calculate a gain on your home is from your adjusted, or your gain on any asset is from your adjusted basis. So when I say about major improvements, okay, that would include, let's say, a new roof. Major improvement is not like any type of repair and maintenance to your home. That's really not a major improvement. Additions to your home. So let's say you added another room to your home. Maybe you added a connecting garage. Maybe, you put a deck on. You did something to that effect. Maybe you renovated the physical structure of the home and, that added value. So maybe you finished your basement after you purchased it. Many things you could do to the property that would be considered a major improvement. So you want to take your adjusted basis and then you add these items to it, well, the purchase price plus these major improvements, that is basically where your starting point for your adjusted basis in the home. Okay, compare that to the fair market value of your home. It's relatively simple. This is going to be the fair market value of your home the date you started to use it for business. Now, this has only really been an issue in recent years since the economic downturn or the housing bubble burst. I know in our area, we had homes in our area that were worth, $300,000-$400,000, in early 2007. By the end of 2007, that same home was worth maybe 180. So, and we're still recovering in our area. Chances are in your area, you may also still be recovering. So before, it was always the adjusted basis for homes because they usually never went down in value. However, now this is becoming an issue for many folks because remember, you can only depreciate the lower of your adjusted basis or the fair market value of your property. And we're going to be looking at this the date you started using it for business. What's the fair market value? You're going to have to use the fair market value if it's lower than your adjusted basis. So let's say, for example, you purchased your home in 2006 for $325,000, and right now it's recovering a little bit, but it's still only worth $290,000. What that means for the beginning part of our calculation here is you're going to have to use $290,000 for depreciation purposes. So that's, just want to make sure you're aware of that. So you got to use the lower. There's probably quite a few people watching this that are still underwater. If you're underwater, you pretty much know if you're underwater from the purchase price of your home, not because you pulled out a bunch of equity, but from the purchase price of your home, you need to use the lower of adjusted basis fair market value. Okay, now you start using it for business. Now, what you need to do from whatever that is, the lower the fair market value or adjusted basis, now you need to subtract the value of your land. So if you're using the adjusted basis, this is going to be a really good idea of, what was land worth per acre, per quarter acre in your area when you purchased the property. That was going to be a really good benchmark. If you bought a house for $300,000 on an acre of land and an acre of land in similar areas, if you're going to build your own house, say it was $25,000, you got a pretty good bet that the value of your land is $25,000. Now, the fair market value, if you're using the fair market value of your home, it's really going to have to kind of do a good estimate, maybe look around, well, you're a realtor, so you could probably figure this out for yourself. The fair market value of the land, right now, if you're using the fair market value of your home, if you took the home off of it, what would that land be worth if it was just an empty lot? So that's a really good way to calculate it. You can probably get some comps on it, and you won't have an issue with this. Okay, so land value. Now, if you don't know what your land value is, and as a realtor, it's probably going to be a big deal for you. But some way I gauge it sometimes for folks when I'm preparing returns is I'll try to get the property tax records. If they have no idea what the value of the land was and you can't go back 10 years to find it, or if you're looking at even right now you just can't tell, you need to have a reasonable way to gauge what you're using for land value. So I'll print out the property tax records, and oftentimes, depending on where they live, it'll show, okay, the value of the building is $100,000, for example, and the value of land is taxed at 15. That doesn't tell me what the fair market value is because it's based on assessor's rolls. But what it does tell me is I got a pretty good shot of whatever the purchase price was or whatever the fair market value of the house is now, including the land. I could say, well, if it was 15% of the assessor says it is, I could take 15% of whatever the fair market value is and assume that's the land and subtract it out. So again, you just need to have a reasonable basis for what you're doing, and then you print that thing out and you got proof. So it's good to have. Now, the land value is when you purchased the basis I said earlier. So if you purchase your house, you want to kind of get an idea what it was then. If you have no idea, this method here would still work for you. Okay, now townhomes. Even if you have a townhome, you got a little bit of land there in the back or the front, so you're still going to have some land, but it's not going to be near as much, and it's not going to be as material to your calculation. But just make sure you include something for the land and subtract that out. So let's do an example here. If you're using adjusted basis, okay, so you purchased the home on 1 acre of land for $150,000. The fair market value, it has risen in price to $190,000. Good for you, good for this person. They got some equity in their home, but they're not going to use this figure, not the $190,000, because it is greater than what they purchased the home for $150,000. So they're going to use $150,000. So, and 1 acre of land cost when they purchased the home was about $15,000 when they purchased it. So the basis of their building, what they're going to be using in their software. Now, different software will do it differently. Some of them will have you, it'll actually ask you what the value of land is and do the calculation itself. And it'll also report land as a non-depreciable asset, which is nice because that's still part of the basis of your house if you ever sell it. Others won't do that. So you got to be very careful with your software. But the basis of the building, you're either going to enter the 150 and then the value of the land at 15, and then the software should calculate. I'm hoping you got to double check this stuff because I'm telling you, it can get messy. The basis of the home and the building should be 135. So this is what you're going to depreciate. So let's continue with our example. Let's say that now we're going to enter the square feet from an earlier section of this course. Let's say the square foot of the home is 2,000 square feet and the office, they're using a room that's 150 square feet. They have a qualified home office. So the business use percentage is going to be 150 divided by 2,000 square feet. 150 square feet, about 2 grand, 2,000 square feet. That gives you 7.5%. So your business basis, the business portion of that home, that $135,000 that is going to be depreciated is $135,000, 150 minus 15,000 for the land, times 7.5% gives you $10,125. That's what's going to be depreciated. You got to go through all those steps, and I want you to check your software if you're doing this yourself to make sure. If you're not doing it yourself, you got a professional, you can kind of double check this, make sure it's done right, and you're learning some tax stuff. So great. Okay, so your home office is what's considered a commercial property. Even though you live in a residential rental, a residential property, a residential rental is it's 27 and a half years for depreciation purpose. But your home office is a commercial property, and it is depreciated over 39 years using straight line depreciation, which means you divide it up by the number of years, and that's how much you get each year. So for purposes here, you got $10,125 divided by 39 years. That's $260 per year, or if you use a part of year, it's $22 per month. Also, the IRS has a table if you started using it for the first year, and there's a calculation the IRS uses. Software, if you're using software, should know that. If you later sell your home, the $260 per year depreciation may be taxable if you have a gain. And we also call it maybe a recapture gain. We call it recapture because it may be taxed at a higher rate. But basically, you get, and it makes sense if you think about it. Okay, you got to write off $260 per year. For some of you, maybe a lot more than that. But you get to write off $260 per year, and then later when you sell the house, what that $260 per year does, it reduces your adjusted basis, because it's your adjusted basis minus depreciation. So that's going to be your basis for selling, or your adjusted basis for selling the property. So in his circumstances there, if he sold it for $190 and you got $135 minus $260 each year, then you add back the land. I'm sorry, I hope I'm not confusing you here because I'm doing this on my head. But a portion of that little $260 each year, over how many years? If it's 10 years, that's going to be $2,600 if you use it for 10 years. That could create a tax. So I just want to make sure you're aware of that. Let's make a couple notes on the fair market value of lower than basis. If you purchase your land for $250 and it's now worth $225, use the $225 minus the value of the land when you started using the home office. Just to reiterate what we said earlier, we gave an example of the adjusted basis where adjusted basis was lower than fair market value. However, here, if the fair market value is lower, you're going to use the lower minus the land. Okay, and the key here for everything I've said is be reasonable. When you're using a fair market value, you have to make some estimates on your own. You can't really prove it. You don't have a closing statement for when you purchase the property. You're using the fair market value. So you may want to do a couple comps just to see if the fair market value is lower. And you have to do this. I know you'll get a higher depreciation, but remember, it's going to be a relatively small deduction, okay? But you're going to get a higher depreciation if your adjusted basis is higher. However, these are the rules that I strongly suggest you follow. So just be reasonable and document your calculations. Now, if you have a home sale in this situation here, it can be really complicated. I want you to get a professional anyways, but if you have a situation where you are depreciating a home where the fair market value is actually lower than the adjusted basis, you have two levels of, I don't want to say basis, but it's calculated in one or two different ways. A loss is calculated one way, a gain is calculated in another, and there's a no man's land in between. And really, that is not part of this course. That is really on a professional level for a course. So if you're in this situation, make sure you get a tax pro to do it. And hey, that is the end of the home office section. And that is really the end of the home office and the auto section together. So thank you so much for watching our video. We hope you're learning a lot, and we hope you continue to learn by watching either more of our realtor classes or by picking another class at Overnight Accountant. Thanks again.